Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. On July 4th, 2025, while most of the country was at backyard barbecues, President Trump signed the most consequential change to real estate tax policy in 7 years. The headline that morning was about something else entirely. Almost nobody covered the real estate piece. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. Today, 100% bonus depreciation is permanently back. The IRS just wrote the operational rules in January, and there's a tax lever you can pull 11 days from now that most of your CPAs haven't called you about yet. The shock and the January 19 line. Here's what changed. Buried inside the One Big Beautiful Bill Act, OBBBA, Public Law 119-21, was a permanent restoration of 100% bonus depreciation under Section 168K. The TCJA schedule that was taking bonus from 60% in 2024, down to 40 in 2025, 20 in 2026, and 0 in 2027, that schedule is gone. Erased. The new rate is 100%, permanent, no scheduled phase out. That's a structural change. Not a market change, not a rate change, a structural change to the after-tax math on every rental you buy from now on. The IRS made it operational with Notice 2026-11 on January 14th of this year, and there's one technical detail you need to know about the rollout. The cutoff date is January 19th, 2025. Property placed in service on or before January 19th stays on the old 40% bonus. Property placed in service after January 19th, 100%. I'm going to call that the January 19th line. For deals that closed in late 2024 or early 2025, the placed in service date is now the single most expensive technical question in your file. Get the date wrong by even a week, you leave 60 cents on the dollar. If you closed a rental in early 2025 and you're listening to this, yes, this matters for your 2025 return. We'll get to what to do about it in segment 3. Let me show you what the math actually looks like on a real $400,000 rental, because the abstract policy never lands until you see what it does to a real deal. The Phantom Paycheck math. Here's the deal. $400,000 single-family rental, Tier 2 metro, think Indianapolis, Columbus, San Antonio, closed in October 2025, placed in service November, 20% down on a conventional 30-year at 6 3/4. Gross rent $2,650 a month. The deal pencils on baseline cash flow, but barely. Step 1. Separate the land from the building. The local property tax assessor pegs the land at 20%, which is typical. So $80,000 is land. That just sits there for the entire hold. The IRS knows land doesn't wear out. The other $320,000 is the building. That's what depreciates. That's what cost segregation operates on. The baseline, what the IRS gives you automatically, $320 divided by 27.5 years, $11,636 per year, every year for 27.5 years. That's the Phantom Paycheck in its simplest form. Depreciation is income that shows up on your tax return but never in your checking account. The rent still comes in, the mortgage still goes out, the bank account doesn't change. But the IRS treats $11,636 of your annual income as if it disappeared because the building wore out a little bit at a 32% marginal rate. That's the high W-2 sweet spot. Household income between $200,000 and $400,000. That's about $3,700 of tax shielded every year. Automatic, no study, no election. The IRS preloaded default. That's the floor. Here's what 100% bonus does on top of the floor. Cost segregation. Engineering-based study runs roughly $5,500 on a single-family rental. What the engineer does is walk the building, identify every component that's not structural. Appliances, carpet, decorative fixtures, the driveway, the fence, the landscaping, and reclassify those out of the 27.5-year bucket into 5-year and 15-year buckets. The overline benchmark across more than 8,000 engineering-based studies, 24% of the building basis reclassifies. I'm going to call that the 24% rule. Your back-of-envelope estimator, building basis times 24% times your marginal rate equals approximately your year one tax shield. For our $320,000 building, $320,000 times 24% equals $76,800 reclassified. Under 100% bonus, every dollar of that reclassified amount deducts in year one, plus the standard straight line on the remaining $243,000. Total year one depreciation, $85,644. Run that through 32% marginal. $27,400 of W-2 income shielded in year one. Net of the $5,500 study cost, about $21,700 of real cash benefit. Year one. That's a paycheck, a $21,000 paycheck. Your spouse will never see it deposited because it shows up as a smaller estimated payment or a bigger refund. Phantom. Now here's the part I almost left out, and the part that matters most for the expand audience listening. The Section 469 asterisk. Default IRS rule. Rental losses are passive. You can only use them against passive income, not against W-2 wages. The $25,000 active participation allowance phases out completely at $150,000 of adjusted gross income. So, for the high W-2 operator running an established W-2 job at 6 figures or above, the $85,000 paper loss doesn't automatically unlock year one W-2 shielding. 3 paths through. 1. Real estate professional status. 750 hours of qualifying real estate activity plus material participation. Tuesday's blog walks through the qualification test in full. 2. Short-term rental with average guest stays under 7 days plus material participation, but that's a non-rental classification. Sidesteps Section 469 entirely. 3. Passive loss carry forward. The $85,000 paper loss doesn't disappear. It just waits until passive income materializes, or until you sell the property. I'm not going to pretend the asterisk doesn't exist. Most of you who run W-2 jobs over $150,000 won't unlock the full year one shield without one of those 3 paths, but the deduction itself never disappears, it just waits. The calendar lever. So what do you do about it this week? Q2 2026 estimated taxes due Monday, June 15th. 11 days from this episode. If you closed a rental in 2025 anywhere on the 100% side of the January 19th line, and you're planning to claim bonus depreciation on your 2025 return, your June 15th estimate should already reflect the lower expected liability. Pay the higher number on June 15th, and you're floating the IRS $20,000 of your own cash until April of next year. Adjust the estimate, and that $20,000 stays in your operating account for the next 10 months. Free cash flow at zero cost, except for a 30-minute call with your CPA before next Monday. Your challenge today, 3 parts. Part 1, pull the closing statements on every rental you acquired in 2025. Look up the placed in service date. That's the date the property became available to rent, not the closing date. Confirm which side of the January 19th line each one falls on. Part 2, if any are on the 100% bonus side, call your CPA this week and ask whether a cost-seg study makes sense before year end. The study itself runs about $5,500. The year one shield, if you qualify for one of the 3 Section 469 paths, is north of $20,000. Part 3, this is the one with the deadline. If you're already planning to claim bonus on your 2025 return, recalculate your Q2 estimated tax payment before June 15th. That's 11 days. The lever is biggest when you pull it now, not in April. Then what? Take the reduced estimated payment savings and earmark it for the next acquisition's down payment. The Phantom Paycheck doesn't show up in your checking account by accident. It shows up because you went and got it. Make it work for door 6. Next episode, $50,000 just landed in your brokerage account. An inheritance, a bonus, and equity payout. Where it goes determines whether you build 4 doors or 1. We'll walk the decision framework. I'm Martin Maxwell. Keep learning, stay strategic, and keep building, one step at a time.